Today's stock is one that I've been watching really closely lately, and that is ticker symbol OSCR, which is for Oscar Health. And this company is a health insurance company that is aiming to reshape the industry by harnessing the power of technology to make insurance more efficient and effective for its patients while also saving them money. Now, I do not have a nice, pretty presentation that is anywhere near recent. What you're looking at right now is a slide from their 2024 investor presentations. So basically, the only important thing here is just to reiterate the mission of Oscar, which is to make a healthier life accessible and affordable for all. That is the company's goal. And like I said, they do that by integrating technology into their platform. They handle a lot of things virtually, and they also are integrating AI into everything they do, which should, in theory, resolve customer issues more quickly. It should make things more affordable for everybody, and it should find efficiencies as far as like reinsurance and keeping the balance sheet more safe. When the company does take large financial losses, which is common for all health insurers, it's not something that I am calling Oscar out for specifically. Every health insurer will go through that. So hopefully, as this company harnesses AI, we will see much better implementation, not only of customer outcomes, but also of balance sheet safety. But over the last couple of months, it has been a bit of a bumpy ride if you are an Oscar Health investor. And a lot of that isn't necessarily due to anything that Oscar Health is doing on its own, but it is a symptom of a larger industry trend. So as this Barron's article says in the title, insurers are in trouble, analysts say. And as I said, this is an industry-wide issue, but analysts specifically talking about Oscar see enrollment numbers decreasing in 2026, which is far worse than the estimate originally of 18%. They now expect the company to lose 30%. Even if they increase their premiums by 25%, that would not make up for the loss in customers. The other thing too is that Oscar Health has seen its medical loss ratio increase significantly, which means that more of the rate premiums go towards paying for their customers' health insurance, which means, of course, lower profitability. And once again, I want to reiterate, this is not a problem specifically with Oscar Health. This is across the board. As one of the major companies, Centene has pulled its year-end guidance due to higher than expected market morbidity, which essentially means more illnesses and deaths that they'll have to pay for. And Elevance Health has also come out and said that they expect to be paying more for medical services, which will rack up more costs for them. Add on top of that the changes to the Affordable Care Act that are occurring under the One Big Beautiful Bill, and we could see premiums increase up to $485 per person a year for the nearly 180 million Americans that are on employer-based coverage. And that just means that a lot of people will either choose to not be covered or pay for cheaper coverage because not everybody can afford an additional $485 a year on their health insurance. So with all of those industry headwinds going on, it's not surprising that Oscar Health misses its Q2 2025 forecast, and that led to a decent drop in the stock, although it did kind of recover in the weeks following. But essentially, the company posted an EPS of negative 89 cents per share versus a forecast of negative 84 cents, and revenue missed, coming in at $2.86 billion against the expected $2.92 billion. Now, these aren't large misses by any means, but when you're a company that's expected to be growing earnings very rapidly and then suddenly you're missing your earnings estimates, people will start to question what that growth engine really is capable of, and that's why we saw the sell-off in Oscar. If we move down to, again, what I think is really important to highlight is that the company's medical loss ratio was at 91.1%, which is an increase of 12 points year over year. That is exactly what I was referring to when I said that customers were using their insurance more often and it was leading to higher costs for insurers. A 12-point increase or a 12% increase in medical loss ratio is significant. And unfortunately, a lot of other of Oscar's competitors have said that they do not see this trend pausing or reversing anytime soon. So I think we will see higher medical loss ratios into the near future, and that is not going to be good for Oscar Health. So that was a brief introduction to the company. Really quickly, before we get into the numbers on Oscar Health, if you could take a moment to like this video and subscribe to the channel, it means a ton to me. But with that, I'm going to stop wasting your time. Let's get into the numbers. Oscar's revenue growth has been exceptional over the last 5 years, growing at a compound annual growth of nearly 130% per year. So that is absolutely nothing to complain about, and there's been huge growth there. What has stalled is the company's EBITDA growth, which shows as negative because it started as a negative number. But as we can see in 2023, it was at negative 159. Then it went to positive 90 and is now kind of stalled at negative 100 due to the fact that we have had those higher costs in the last year. But what is reassuring is that free cash flow growth has been at about 23% per year. So Oscar is still growing its free cash, and that is always good to see. Margins show up all over the place, especially in 2020, but if we ignore 2020, we do see general improvement in most margins from 2021 through 2024, and we are seeing a bit of a reversion back to lower margins here in 2025, again because of medical loss. I do think it's important to point out as well that the current operating margin of negative 1.2% is expected or hoped by company management to become 5% by fiscal year 2027. So management at Oscar does believe that profitability is very near for this company. Both assets and liabilities have grown really nicely over time. That is to be expected given the very fast growth of Oscar Health. Although I do want to point out the quick and current ratio sit at 0.75. Typically anything below 1 is considered a little bit risky. Although again, if we take a look at the chart, we can see that total assets of $6 billion outweigh the total liabilities of $5 billion. So I don't believe Oscar is in any sort of major balance sheet predicament at this very moment. The company covers its interest tremendously, so there's really not much to talk about here. And when we look at annual shares outstanding, it's important to note that Oscar went public as a SPAC in 2021. So that huge jump in shares outstanding from 2020 to 2021 is simply a reflection of going public. But we did see a very large and rapid growth in the number of shares outstanding through 2024. And then the company did start to buy back some of its shares into 2025. I imagine that's probably going to slow down due to the fact that medical losses and other issues will inevitably lead to less free cash for the company to spend on buybacks. But it is good to see that management is interested in watching out for its shareholders. Oscar Health does not pay a dividend, so we will skip that part and we will move on to price to sales, which is currently sitting at 0.41, which is nearly 40% below its long-term average of 0.68. Now, what I do want to point out is that the average price to sales is heavily skewed by the early IPO of Oscar Health. And so if we ignore much of 2021, I think that would skew the average lower to something closer to like 0.5 in this range here. So just imagine a line where the bottom of that box is kind of going across somewhere in this area, I believe would be the long-term actual average. So Oscar Health is still trading at a slight discount to its long-term price to sales, though that discount is not nearly as large as this chart would suggest. Because the company has not been consistently profitable, price to earnings is kind of useless for us to look at, as well as price to EBITDA. It just creates a ton of noise. Price to free cash flow is interesting, and the company is trading at a price to free cash flow of 4, which is exceptionally low. Although I will caution that a lot of these health insurers will see large fluctuations in their free cash flow. So what would be a very low ratio today might be a more normal ratio next year after normalization of free cash. But with that said, Oscar does look like it is decently cheap on a free cash flow basis today. The company's price to book value currently sits at 5.33, which is a lot higher than it was trading for in 2022, 2023, and even into 2024. So while the company looks cheap on a free cash flow basis, on a price to book basis, it might be a little bit overvalued. Although I will say that because the company focuses heavily on technology and streamlining its processes with that technology, it may carry a smaller book than your typical health insurer, meaning its price to book value would be a higher number. Again, due to a lack of profitability, EV to EBITDA is not going to be very useful, but EV to free cash flow might be a little bit better, with the company currently trading at 5.77. So again, its enterprise value to free cash flow number is quite interesting, can fluctuate quite a lot due to the fact that free cash flow is a little bit more variable for health insurance companies, but there are certainly plenty of companies out there with far worse EV to free cash flow numbers, so this is certainly making Oscar appear interesting. Taking a look at the company's drawdown chart, since IPO, the company is down 55%, and that is largely due to the fact that it IPO'd at $10 and almost immediately tanked. It did not have a very good debut following its special acquisition. But if we ignore the initial downtrend that occurred throughout 2021 and 2022, we can see that Oscar Health is trading quite healthily near its local highs. And so I think the company is generally in a decently solid uptrend. Now, what is not good news are the company's earnings estimates. Now, Typically there are three lines here, but two of those three are kind of hidden behind each other, the lightest blue and then this kind of medium blue just above it. Those both represent the 3-month and 6-month ago analyst estimates, which were very positive for Oscar. As we can see, they expected Oscar to earn 75 cents per share this year, just 6 months ago, even 3 months ago. This dark blue line represents what analysts now believe will occur for Oscar. And so they now believe Oscar will lose $1.38 in this fiscal year. In 2026, they expect the company to lose 40 cents, and they believe that profitability will finally be achieved in 2027. That is a very large delay compared to the expectation of being profitable this year. And so you will see a lot of analysts are getting quite bearish, I think, on Oscar. So using current analyst estimates, what we can see is that the forward implied price to earnings ratio for Oscar, of course, is negative because earnings are negative. But if we look at the 2027 implied earnings, the price you're paying today for Oscar would be approximately a 15 times earning multiple on its 2027 earnings. Now, for a company that's growing as fast as Oscar is, that sounds very, very inexpensive, to me at least. But we also need to keep in mind that Oscar just saw a huge down revision to its earnings. So that could mean one of two things. Either this 15 times earnings is still quite optimistic and Oscar will earn a lot less in 2027 due to the fact that there are so many industry headwinds going on, or this is a level of bearishness that is very short-sighted on analysts and the market perspective, and the company will earn much more than analysts currently expect and maybe closer in line to what they expected 3 and 6 months ago, and that implied forward PE would be much lower, meaning that Oscar is a great deal. It's just something to think about, and it's something that I wish I could personally predict, but unfortunately I do not have a crystal ball. Otherwise, I would love to tell you where the company would be in the next couple of years. So with that, let's take a quick look at the X factors for Oscar Health. First and foremost, the 5-year expected growth rate is 12.31% per year for the next 5 years in its earnings. Now that is pretty solid growth. I will say it's probably muted compared to what it has achieved in the past. Again, that reflects industry headwinds, but analysts still believe there's going to be significant growth for Oscar, even including those headwinds. The PEGI ratio, which takes the price to earnings and compares it to the total return of the stock, is negative, largely because the price to earnings ratio is currently negative for Oscar, so it's not very helpful. But what I find very, very interesting is our FG ratio, which takes the enterprise value divided by free cash flow of the company, so another way of looking at profitability, and the value that you are currently purchasing the company at, and we compare that to its long-term expected growth and yield, which in this case would just be its growth rate because they do not pay a dividend. We get a ratio of 0.18, which is exceptionally low. Anything under 1 is considered very good. Anything under 0.5 is kind of ridiculous. So 0.18 is kind of unheard of. And as I mentioned, free cash flow is highly variable in the healthcare industry. It's possible that Oscar's free cash flow will moderate in the next couple of years. But in case it doesn't, you're getting an extremely good deal on this company based on its enterprise value and free cash flow numbers. So, final recap of the company. First and foremost, I give Oscar a safety score of 3. The reason I give it a 3 is because the company is very well capitalized. It has a ton of cash on the balance sheet, and its balance sheet in general looks quite good, very low debt, all of that. So I do think Oscar is safe from any major industry headwinds. They'll be able to take on losses in a fairly healthy way. The reason they don't get a 4 is because in general, the healthcare industry and health insurers can face quite a bit of headwinds that last, several years sometimes. And so if you take a look at any healthcare stock, that you will see large drawdowns occur, and those drawdowns may be several years in length. So that's just something to be aware of. Just in general, the industry is not the safest industry to invest in. Next, its quality score, I give it a 2. That's largely because I'm comparing it to industry giants like your United Healths, your Centene's, etc. And the reason Oscar just gets a 2 is because Oscar is small. It's a new company. It seems to be executing very well on its mission, but healthcare companies in general are safest when they are largest because they have that financial protection as well as a little bit of government protection to make sure that they continue to prosper, continue to continue their operations. And I don't think Oscar has achieved that level of size yet to where Oscar becomes so important that it cannot fail, and that it becomes so integral in the American life that there is no way that it possibly could fail. So we just haven't reached that yet. And again, because the industry itself is quite volatile at times, that's why it gets a quality score of 2. Next up is value, and the reason it gets a 3 is because we are trading slightly below its average price to sales. We're trading slightly above what I would say its average price to book is, but on a free cash flow basis, Oscar looks like an excellent deal today. And if the company is able to deliver any sorts of major, free cash flow growth at the 10, 12, 15% that its earnings grow, I think Oscar represents a very good value today. The only reason I didn't give the company a 4 is because it is such a young company. It is quite difficult to put a solid estimate on what to expect from this company in the long term, because nobody really has much to look at in the past from this company. So it's hard to say it's an excellent value today. But if the company was to drop to the single-digit share prices, I think it would be a very, very good deal. And then finally, for the X Factor, it gets a score 2 out of 3 for the growth as well as for its FG ratio. I think the PEGI ratio would look quite good on this company as well once the company does start earning an economic profit. But I can't give it a perfect 3 out of 3 because its price to earnings ratio is negative. And so therefore our PEGI ratio is sort of useless. But all in all, that gives Oscar a score of 10 out of 15, which, to be perfectly honest, I feel is a little bit low given the company's growth potential. I would personally rate this as like an 11 or a 12. And the only thing that I would say is that the share price of Oscar today, I think, might be able to come a little bit lower. I'm perfectly comfortable with waiting for a lower price with Oscar to see if those industry headwinds will cause issues with this company or not. Because I do think at the very least, industry headwinds will cause bearishness for the underlying stock, even if Oscar continues to perform as an amazing company via its income statement, its balance sheet, its free cash flow, all of that sort of stuff. So for me personally, I'm watching Oscar Health very, very closely. I check in on the stock nearly every day just to see where it's trading. And if the stock was to ever drop down to a $10 range, even like a single-digit dollar range, I would be very, very interested in picking up this stock. So those are my thoughts. Again, as always, this is not financial advice, so please come to your own decisions, do your own research. There's plenty to learn about this company yet, but I'm interested to hear from you. I want to know what you think. Is Oscar Health an interesting company? Are you watching it? What do you like about the company? What don't you like about the company? And are there any other stocks out there that you are watching more closely than Oscar? I would love to hear about it so I can take a little dive into those as well. So with all of that, I hope you guys enjoyed the video. Please don't forget to like and subscribe to the channel for more videos like this. And with that, I hope you have an amazing day. Bye.